Moving on with our 24 examiner secrets for the AA examiner. This time we're looking at non-audit services. So you're doing an audit, but you're also doing their tax return, for example, or you're also doing their accounts. Now there's risks to that, isn't there? There's ethical threats. So if you're doing the tax return, if you're doing their accounts, there's self-review. Maybe the non-audit services bring in loads of money, so there's self-interest, there's familiarity. There's all sorts of risks with non-audit services. So what you could do then is you could put a cap. And what I mean by that is, this is KPMG's number actually, that the non-audit service needs to be less than 70% of the audit fee. So that's one way of doing it. Another way of doing it would be have different teams, so segregation of teams. And that might also be a safeguard enough. So a combination of those, but it gets quite tricky. Now, if the examiner asks for a non-audit service on a contingent fee basis, a contingent fee is when the fee depends upon something else happening. And we don't like that in general. It makes all the risks, all the threats even stronger. So when it's a non-audit service on a contingent fee basis, if it's material, there's basically no safeguards. The only time you could do a non-audit service on a contingent fee basis is if the item's really, really small and therefore not material. Okay, so let's go and have a look at the December 24 exam. There's two additional services which were non-audit services. Which ones can we accept on a contingent fee basis? As soon as you say that, you think, is it material or not? So here's the question, and it says they're likely to be material to the firm. As soon as you know it's a non-audit service on a contingent fee basis and it's material, you can't do any of them. Okay, keep watching out then for this series on the tricky questions in ACCA AA from the December 24 exam.